I've had probably, I don't know, 5 or 6 deals lately where lead comes in, looks good. I mean, there's definitely some level of financial stress or motivation there. We walk it, we get the property under contract, we take it to title, and we come back and the payoff is $20K more than than we need like our contract price for.
Hey there. Welcome back to today's episode of the Collecting Keys Real Estate Investing Podcast. This is the podcast where we teach you to make massive income, not just passive income with your real estate investing business. If this is your first time here, I am your host, Dan Austin. And unfortunately, my co-host, Michael DeHaan, is MIA. We don't know where he's at. He's out somewhere gallivanting. If you find him on Instagram at Mike_invest, let him know. It's an unfortunate situation. I don't think we've ever had a Mike and Dan show that wasn't Mike and Dan. This is the first. There's a first time for everything, but we're here. We are saved with the fan favorite, our producer-ish / co-host today, Dylan Cook. How you doing today, Dylan?
I'm doing well, man. How are you?
Yeah, I can't complain. It's a rainy day in the Northwest, which is unfortunate because we're in the middle of June. That kind of sucks.
We have like a heat wave over here. It's like 95 plus all week this week. I've gotten 2 calls for HVAC this week already.
Seriously? Oh.
Yeah, seriously.
That sucks, dude.
Yeah,
dude.
Yep.
Yeah, our I don't think our heaters or air conditioning have ran in like 3 months just because it's been like this steady 50-degree flat, disgusting weather. And actually, my wife and I were watching the news the other night, and there was like, oh, there's a heat wave, and I'm like, whiners, bunch of whiners over there. I was like, I'll take some of that.
And then, sorry to the listeners if I sound different. I'm getting over something. I don't know what it is. So if I sound a little bit better the following week, but
AIDS.
Yeah, I think that's a leading candidate. I thought too. Those tests take a little bit to come back though. So fuck you, dude.
Oh man, dude, that's such a bad story. This is a total side tangent. See, this is what happens when Mike's not here. So when I was in the Army, we used to have to get AIDS tests every 6 months or HIV tests every 6 months. And they would mail them to the barracks where everybody lived. And they were just like a little note card, right? And it just said, you have AIDS or you don't have AIDS. It was that simple. And so one of the guys didn't get AIDS. Sorry.
Oh, damn, dude.
he got the card,
yeah.
Right? He got the card, right? And their check mark was like worn off. So somebody else put it that you do have HIV and gave it to the guy. And he's like, hey man, I got some news to break to you. And the dude for like an hour thought he had HIV. It was the worst. It was the worst joke to play on somebody else. And then they're like, gotcha.
I think what's worse is like, shit, is that believable? Like, you're like questioning all your life decisions up until that point.
He's like, how did I get AIDS?
Yeah.
Oh no, it's the toilet seat, man. I guess that's what it was.
Well, on a lighter note, I'm going to celebrate a small win this morning. We got a 6-unit apartment building under contract this morning. And
nice.
Shout out to Simply Leads. There's a cold call from you guys that first got it on the books. And then I went out there yesterday and she signed this morning. So,
dude, that's awesome. So how did that's actually pretty good. So a 6-unit, you signed it. They came in and you basically signed it around in the same week. Oh
yeah. So, I mean, this person had some levels to motivation, whereas one, they inherited it from their parents in like 2002. And her and her husband, who live in the property, are getting a divorce. So they're currently living in 2 separate units of the same complex.
Nice.
And in part of their divorce settlement is they have to sell to get some equity out. Right. And so it was just like, I think it was a good timing. We hit them at the right time.
That's
kind
awesome.
of a thing. And came to, our numbers make sense. It's not a home run deal for us by any means, but it'll be a solid base hit.
So will you keep? Is it a keeper?
I'll keep it. Yeah.
Yeah.
Definitely.
That's awesome. Multifamily like that is legit. And if you guys are curious about Simply Leads, go to simply SIMPLI leads.net. We don't have .com yet. We're in the process of buying .com. I'm so embarrassed to say .net, but we will buy .com so we can say simplyleads.com. And thanks for that shout out, Dylan, because I talk to people a lot about calling and texting. And I always say, we're not like warm calling, we're cold calling. And so you got to follow up with these leads when they come in. A lot of people get discouraged. They try to just read the notes and say, oh, this one, they said they want retail value. I'm not going to call them. It's like, yeah, everybody wants retail value. Everybody wants more than retail value. So you got to do the follow up. You got to do the calls, and it helps. It pays off. So that's good to hear.
Yeah,
man.
Absolutely. Don't get me wrong. Like, I think there's an analogy out there of like what every 999 calls, you get one one deal or something or whatever it may be.
Absolutely.
And if you get that too early, but yeah, no, it worked out great for this one, and we'll keep it. Add 6 more units to the rental portfolio, and hopefully there's more to come.
Love it, dude. Yeah, it's funny you say that. So I was just doing the scale coaching call today, and I told a story about, it was a cold call that we got here in Spokane for one of our deals, and it came in, the ARV of this thing was like 475K. The guy wants 435. So it's one of those where you're like, dude, like there's money right in front of me, but there's not enough room, and it's a turnkey 2017 built, really nice property. And anyways, like we're like, man, if we can get him at 400, we can maybe do something with it. We're just not sure yet. So we're debating, like, should we run the appointment? Should we not? We just decided to run the appointment. So go out there, guy's super nice, great appointment. Turns out that the guy's like, you know what, I should just list it. Like it makes more sense. And we're like, you know, honestly, we think it does too. Like we could get you money fast, but you're going to lose so much equity that you don't need to lose. He's like, but my mom's moving with me, and her house is a shithole. Would you guys want to buy her house? And we're like, absolutely. So we're gonna run an appointment on it. It's just like one of those things where do your follow up, you know, kind of run these leads out as far as you can, just to make sure there's no opportunity, because we get referrals all the time. Sometimes there is just hidden distress that you find when you show up, and you can work with them. There's just so many ways to make money in this business. Don't prejudge anything.
Totally. And it's funny you say that, because I've bought in 3 houses from 3 members of the same family, from that same exact,
really?
Like, yeah.
Dude,
yeah. It was
awesome.
the parents, and it was a daughter, and then the another daughter. So her sister.
Yeah, man.
They all make pretty bad decisions, but it worked out in our favor.
It works out good decisions for you.
Speaking of greedy investors buying a bunch of real estate, though, how about, I'd like your opinion, Dan, on legislation was presented to basically, excuse me, ban hedge funds, quote unquote hedge funds, from buying basically single family homes entirely. Right. And they would have 10 years to basically dissolve their current portfolio. Offload them.
Yeah. Okay.
Right.
Interesting. So a couple questions. If you know this answer, you might not, is what defines a hedge fund? Because like, would like JP Morgan Chase, like a bank, be considered a hedge fund because of just like a size, and they're just using that term, or what?
So they do have a brief definition, but I think this would get further ingrained. But here I did have it. Basically, it was anyone who controlled other people's money, essentially. So yeah, JP Morgan, or what is it? Blackstone would qualify. A lot of the people out here would all qualify for these kind of groups. But just some, like, it depends on who you ask in these market studies, because they had one group, the Urban Institute, which said that 574,000 single family homes are owned by large institutional investors of at least 100 properties as of June 2022, which they said that was 3.8% of all single family rentals. Be specific with the rentals part there. And so you're at 4%. But then if you go a different group, right? Let's see here. The National Rental House Council puts the same ones at 145 million in the country, which 0.04% of homes. So there's like this is a big difference on who you ask, how they're doing these studies, right? And so the larger context question is why are these retail people buying homes like post 2008? Yeah. And then 2, should they be allowed to do it?
So that I love how you explained how they cut the data, because like it makes no sense when you're like, oh, it's 0.04% of homes. Like that's a pretty small number. And even like, to be honest, like 3.8% of single family rentals, where that study is, like, that's really not that much in the grand scheme of things. Like I'm actually surprised it's not higher. Right. You know, you think about all the build to rent, all the acquisitions from hedge funds and iBuyers and all that stuff out there. And then all the mom and pops, compared to that, to all the mom and pops, I just thought mom and pops would be so few and far between, but I guess everybody's buying rental properties these days. So to me, it's not that large of a number. I think that it is a political ploy, because everybody's saying, oh, these hedge funds are buying up properties and driving up home values. I don't think that's the case. I do think that they've helped kind of float it up higher, but I don't think they're buying enough. I think there's enough dumb people out there overpaying for properties as well, that if anybody's going to push it up, it's going to be those people.
No, I tend to agree with your line of sight. And when I was reading this, I was just kind of thinking, like, you know, well, one, why are they buying, these assets in the first place? They, like, historically, I think Wall Street hasn't really been single family home buyers, right?
Right.
And you go back to 2008, I'll try to find this chart, but like they were building like single families were getting developed, and then it fell off a cliff and they didn't come back for like 10 years. Right.
Totally.
And so there's what this says 4 to 7 million homes short right now for like people in the United States. Obviously it's geographic dependent, but the reason why prices probably are still remaining high is there's just not enough freaking homes.
See, that is interesting, actually. That's a great point. So there's not enough homes. And I tend to believe the study, but I also know like real estate's hyper local. So like where we're at in Spokane, like we were one of the hottest markets in the country for a while, like in the 21, 22 buildup. I don't know. I feel like everybody has a house though. Like, I don't feel like we're running out of houses. Like nobody here that I know, they're like, dude, I just can't find a house. Like even when the market was super hot, it wasn't that they couldn't find a house. It was that they couldn't find a house they liked. There's plenty of houses.
Yeah.
So I wonder though, are these large metros though, like New York City, San Francisco, LA, where like they just can't go anywhere else. And everybody wants to be in this densely populated area. So there is a shortage.
Yeah, no, that could be it too. Or are people like co-living more? You know, they have a roommate longer than they traditionally would have before. It's
possible.
Or or co-living longer. I don't know. There's something like that, but definitely the 50 metro areas, like the biggest metro areas, are probably impacted by a little bit more. Totally. But anecdotally, hedge funds were big in Cincinnati, like for a while. Yeah. Like I have sold to hedge funds in the past. Yeah. And when some of them came into town, I would look at what they're buying at, and I'm like, there's no way that this is going to like continue. Right. Yeah. And guess what? A lot of them are selling a lot of their stuff because they're forced to now. Mm-hmm. And so I think people see the headlines and they think that they should be regulated and they should, have their hands tied because they want this immediate satisfaction or gratification. Yeah. But I think if you just let the market do its thing over a long enough period of time, it's going to work itself out. Because that's what I'm seeing here.
So when you talk about that, like what ARV, like 'cause I'm sure you went to like Open Door and these other folks and you're just like getting like 96% offers. Like what were they buying at, or were they over ARV?
They were never really over ARV, but and at least in my experience is they would buy the dog shit of the dog shit. And I think they were really underestimating what their rehab numbers would be.
Yeah.
And so they, if something was worth 250K and it still needed 50K worth of work, they would be happy buying at 190, 200K. They don't need a lot of equity. Right. And a lot of them operate off a yield, a cash flow yield, not like a cash on cash, like we would do. So if they could have like a money, like I forget what it was, but it was like a 12% yield on their money, which was like a 3 or 4 year calculation, they would buy it.
Interesting. Yeah. And so fundamentally the hedge fund model makes sense to me if they were able to buy like more turnkey properties at say like 92% or 91% ARV, right? Because a seller is going to usually pay 6 to 8% in sales costs, right? Mm-hmm. So if they can get all their sales costs wiped out and the hedge fund's getting it at a discount, they're acquiring it at a discount, there's some ARV margin and then like immediately that they're buying into, and like they can get their cash yield or whatever. And also they're getting the value of the appreciation, depreciation, all the other stuff that comes with real estate. And they just happen to have a shit ton of money, right? And so if they can aggregate it, all the benefits together and hit 10 or 12%, they might be able to. But if you're going and buying junk properties, that to me just I know like it's hard for me to scale up junk properties. I can't imagine some Wall Street dork who's doing it remotely, doesn't really know what they're doing, or they've got some boots on the ground guy that's just running around, doesn't know anything, right? Collecting salary.
They were a sale, like their number one guy, like my contact was a sales dude. He was paid on commission.
How many he can buy, right?
So yeah, and so he was. I'm sure he was kind of finagling things a little bit.
Oh yeah,
right, a little bit. So he got paid a little bit more. But they went belly up quick, and not to put a side tangent, but the day they went belly up, I had like 3 deals in escrow with them.
Oh, so I remember.
Yeah, I had to go back to those sellers, and we still ended up buying all of them. By the way, they were for a little bit less, but yeah.
Heck yeah, dude, that's good. Good on you, man. Yeah, I guess to like kind of round out this discussion, like it is kind of a weird time in real estate because there is like the boomers are dying in place, I would say more than any other generation, because the boomers are the second biggest next to the millennials. Right. And so I've always kind of had this like thought in my head is like boomers are dying in place, and then millennials are, delayed buying homes. So kind of like there's this huge influx of demand, which are the boomers downsizing and moving into like their little retirement home instead of going to retirement community. And the millennials first, like trying to get their first property in their 30s because they couldn't do it in their 20s, right?
Right.
So there's this huge demand. And then, of course, at that same time, 2008 basically hits, the building stops. So I think it was like a perfect storm. And then COVID exacerbated that by just falsely inflating, by giving people too much money. So I just feel like we hit like this unprecedented storm that is not like, that is unique, that we're not going to see. And the need to regulate it just isn't actually there.
No, I would just echo everything you just said. But you touched on like millennials, like delaying their first time home buying, especially compared to their parents and et cetera. Mm-hmm. Another thing that kind of caught my radar was something by Bank Rate. And they basically said like, it's like the whole renting versus owning debate, right? Mm-hmm. Is it cheaper to rent or is it cheaper to own? And their consensus was, it's always been popular to own real estate because you get all the benefits that we just described: appreciation, debt pay down, interest expense, et cetera. But with the combination of interest rates basically skyrocketing the past couple of years, insurance, property taxes, and just to maintain a piece of property anymore, like the cost to replace things going up exponentially. I was going to read what they have here, and then you can kind of give your 2 cents. Nationwide, the typical home costs nearly 37% more to buy than to rent on a monthly basis. Rent increases have softened across the U.S. over the last year, and the combination of high home prices, elevated mortgage rates, and low housing inventory creates a strong headwind for aspiring home buyers. Additionally, it's cheaper to rent than to buy in all top 50 metros. The typical monthly mortgage payment of a median price home, according to Redfin, is $413,000. Of $413,000 is $2,700 a month, while the national typical monthly rent is $1,980 a month as of February, which is like a 37% difference between those two numbers.
That makes sense. And that doesn't even count the maintenance and cost of owning a property, right? So I was actually just having this discussion internally with myself the other day about just like the home maintenance. And like I was telling my wife, I was like, yeah, we should just like sell our house and like move into like a condo where we don't have to worry about anything. And like in the impetus to that conversation so I've had a lawn maintenance guy do my outdoor lawns for the last 5 or 6 years, basically, well, maybe longer than that, since I started owning rental properties. So 2016, because you start buying rental properties, it just becomes, better to just have your lawn guy swing by your house to mow your lawn. So I've been doing that forever. And then this year I was like, I'm gonna do the lawn this year. I got my son. He's like all giddy about things with motors in it. So we bought like a riding lawnmower, did all this stuff. And I'm like, I absolutely hate this. I was like, I have no business doing this. I don't want to mow my lawn. I don't have to mow my lawn. And then I was just thinking about all the other stuff that you have to do from a home ownership just to keep up on your property so that it doesn't become a distressed property that we go in and buy. Right. And it's a lot, man. It's a lot. And then you include the cost of debt, like the appreciation that we're going to be seeing. Like if you're a home buyer today and you're buying a home, the appreciation you're going to see going forward and the debt pay down you're going to see going forward just isn't really a benefit right now for you. Over 30 years, it's still going to be a benefit on the macro level. But I just think that 2,700 versus 2,000, go ahead and throw on another $400 to $500 a month and just general maintenance that you have to do. It's kind of like owning a car. You got to buy tires every 4 years.
Yeah,
whatever.
Least.
You know what I mean?
At least that, yeah.
So it just like adds up, and that $2,000 a month seems pretty cool when you can just walk out, lock the door, and leave.
Yeah, and if something breaks, call your landlord; they'll fix it.
Exactly. Shit rolls downhill. Yeah, shit rolls downhill. But that's a huge thing, and I'm seeing a lot of people renting, like in our home market, but I'm not, like for us as landlords, I'm actually not seeing our rent go up, which is not cool, just because for whatever reason, the rental market where we're at's gotten pretty soft. And so we're renting for, on average, I would say like $50 to $75 less a unit today than we were when we first leased those, when those leases were rolled. They're rolling now a year later. Yeah. It's kind of not ideal. I don't know how you're feeling over there, but
I mean, anecdotally for us is like, when I think when I bought my first property in 2018, I remember underwriting places at like $500, $600 for a 1-bedroom.
Right.
And now like you can't get anything for probably less than probably $750, $800 here for like in a decent area. But no, I mean, my market in Cincinnati is definitely still investor friendly. We have good demographics for that, but it has definitely softened, right? Like we took over that 13 unit building and the place is now half empty, and I'm going to start throwing these places up for rent. So I'll have a better understanding here coming soon.
Right.
But I did have to underwrite conservatively, on what I think I could get in rents when we were doing that.
Yeah.
That deal.
Yeah, totally, dude. And it's like, the numbers where they're saying like $1,900, $1,970, $2,000 a month. I'm like, dude, what are these people? These must be the coastal elites that are elevating and buoying up the rest of the average. Because when you're talking about yours, your rents being at that price, and then in Spokane, I would say for like a 2-bed, 1-bath, we're looking at like 1,200 to 1,300. If you're in a nicer area, it's higher. But I bring that up because like the margin of going up and down really isn't that much and hasn't been that much for us in that same period of time. Like you're saying 500 to 800, like that's in the grand scheme of things is not that much more money for you. At the same time, your taxes and insurance went up, right? And debt service costs went up. That really is just kind of following what your additional costs have gone up, where like you would be hoping that you went from 500 to 1,500 overnight.
Yeah.
That's really hard to do.
I had another wholesaler reach out to me the other day and he's like, "Hey, you still buying?" I'm like, basically said, if it's a single family, I'll flip it. But anything like for buy and hold, I really can't make pencil anywhere. Like, right. And so I don't know if I'm not underwriting appropriately. I think I am, but it just isn't worth the squeeze at this point for me. I'd rather just flip it, make the 20 or 30 and then keep the multi-units. So. Yeah.
And that's, we feel the same thing. Like, I don't know that we've bought a single family home in a year and a half now. We've sold some, but they just they don't make sense really in any market right now. And even if you're going to like a cheap market where you're like, I can get 1% rule, that's cool, but it might not be cool in that market, right? You still might need to be underwriting 2% in that cheap market, some like Southeast market where there are a bunch of hillbillies out there playing hammer darts in your
How are property taxes up in your neck of the woods?
They're not like crazy Texas crazy, but they're decent. Like they're where I live specifically, the school district is pretty expensive. So ours are significantly higher in this kind of region of our town. But on average, if you look at like a $300,000 to $400,000 house, you're going to pay about $4,000 a year in property taxes.
Honestly, that's probably about the same. I think Ohio surprises a lot of people with our property taxes. Like it's usually pretty high. It can range from 2.5% to 3% of your assessed value.
Yeah, that's pretty high. We're right around like 1% is where we're kind of hovering.
Yeah,
just depends on the school district and the different like assessments they have in your area. But yeah, I mean, it's definitely killed us because these property taxes, like yes, the values of the homes went up. But so did the taxes quite a bit. They actually, so our assessor has a tool now, and we're maybe behind the times, but it used to be, they didn't really assess it until the property changed hands. They just didn't have a good way to do it. Every like few years, they would try to reassess it with a drive-by, and they didn't have a good tool. But now they have a tool where they can live every day if they wanted to. They could change the price because the tool does a live assess, like a live comp, live comparative analysis. And so it kind of stinks because, your house goes up in value with the market, and then it likes to stay above value when the market goes down. Isn't that funny?
Yeah. Ours is every 3 years. The reassessment.
Oh, that's not bad. Ours is annually, dude.
Ours is every 3 years. And I mean, that's a specific county. There's other neighboring counties that are once a year. But
yeah,
I mean, and I want to get your opinion on this, Dan, is that, so I've had probably, I don't know, 5 or 6 deals lately where lead comes in, looks good. I mean, there's definitely some level of financial stress or motivation there. We walk it, we get the property under contract, we take it to title, and we come back and the payoff is $20K more than than we need like our contract price for.
Yeah. We just had that one. It was $80K more.
Yeah. Right. And so I guess are more and more people, and the trend I'm trying to put with that is a lot of these people refinanced when it was hot in 2020, 2021, or they recently bought and they're having a tougher time, I guess, keeping up with those payments. I don't know what it is, but it sucks because there's not really a way around it other than a short sale. And like,
totally.
Like they're still going to lose out on that.
Yeah, exactly. Someone's going to have to lose, right? I don't know if it's going to be the bank or them or who's going to lose, right? Someone's going to have to come to the table with money. Yeah, we have seen just recently on that same topic, like folks that have gotten like like throughout COVID, like got some special lending and did some special stuff that I don't know about, like not forbearance or anything like that, but like second loans on their house. Like we had one that was like an actual like second loan that they didn't actually really know. They were under the assumption it would be forgiven. And so I don't know what they did. It wasn't like a second mortgage. It was just some sort of lien, and it was like $80K. And so we went to do the payoff and it was $80K more than what they thought. Cause like, oh, well, we were kind of under assumption we didn't have to pay that back. So there's people out there like that. And then there's, of course, the forbearance people who tax on the end of their loan,
Right.
which is fine, but it will increase their payoff a little bit. And if they bought it recently, like they bought it in 2020 timeframe, like they're not going to have that much debt pay down and that much equity anyways. And so there's definitely, I wouldn't say we're seeing a crazy amount of it. We're definitely seeing some level of that.
Yeah. I just noticed it a little bit more as of late. I don't know why.
Yeah.
But
we've definitely been like just this year in general been trickling in leads that are like that one I just explained where the guy wanted 470 or 435 for a house worth 475. He was fortunate that he had some equity in it, right? Which he probably put a down payment on.
right. He's
like
his own money back.
Exactly. There's just some of that where you see, people are like, oh, like I want to sell my house and they can't. Like even in my neighborhood, there's people, and I know Mike's had this in their neighborhood. There's people that bought like 2 years ago or a year ago and they're trying to sell their house now. Like that's like the worst situation. You're going to be losing money.
Yeah. No, 100%.
Just on sales costs alone, not let alone any other shit you've got going on.
Yeah. I think we're in a weird time right now. Like you said, we had all these unprecedented things that kind of went on top of each other. Mm-hmm. And I like to follow some of this macroeconomic stuff, and I won't say I'm an expert by any means, but one of the things that is very popular amongst investors of all sizes, including real estate, is the inverted yield curve. Do you know what I mean when we bring that up?
I do, but I feel stupid because I don't know how they calculate it.
Well, no, I mean, so you can take any duration, right? And so it's just like the T-bills to the 30-year, anywhere in between those lines. Mm-hmm. And if you just lay it out, that should be of the y-axis being like how much it is, like its interest rate over time. On the x-axis, it should basically just be a line up and to the right. Because the longer duration out risk, the higher that premium should be to taking that duration risk, right?
Right.
Well, there's been historically, you take the 2-year treasury and the 10-year treasury, and if those ever invert, meaning that the 2-year pays more than the 10-year and vice versa, then that has been like 100% indication of a recession within the next 18 months after it happened.
Okay.
So that first happened though back in July of 2022, and it's remained inverted, which is now the longest streak that we've had that inversion to take place.
That's right? Wild.
So I'm just going to read, here. The 210 curve inversion is a time-honored signal of an upcoming recession. Short-term bond yields more than lower maturities because investors expect interest rates to remain high in the short term as the Federal Reserve battles inflation, while long yields are lower on expectations. The central bank will cut rates to stimulate a weakening economy. So the whole point of bringing this up is everyone and their mother has been screaming recession for like the past 2 years, right? We haven't had it. And so I know none of this is, financial advice, and we're not experts on this, but if you had to give some reasonings on, why it's inverted or why it's remained inverted for so long, where does your mind go to?
So first thing I guess comment as I always like to say this, there's a first time for everything. And I feel like honestly, since like the early 2000s, like maybe it's 2001, like time frame, like I feel like everything's been unprecedented. Like, hey, we've never seen that before. Like I feel like as an adult, everything has been like, we didn't expect that. But then I have to go back and say, well, what about the 30 years prior to that? Or is that the same thing? The 80s, the 70s, all the issues we had then, like we never expected that. So none of this shit's ever expected. And I feel like I have a gripe with economists, and that is that they are absolutely like impeccable historians, but they don't know what the fuck they're talking about when it goes to what's going to happen next, right?
Yep.
They all will have it. And sometimes people will guess and get right, but they will be able to, like when I got an MBA, took macroeconomics, like they can literally break down with precision exactly what happened, when it happened, who did what, and tell you exactly why. And then they'll put their own political bent depending on who they voted for.
Sure.
And that's the lens you'll get, right? So great historians, but not great at forecasting the future. Part of me would say, why is this happening? You said this first happened in 2022 is when it first inverted?
July of 2022, yes.
Yeah. So I think we had COVID, which was unprecedented. We had unprecedented like shutdowns, spending. And in 2022, things started happening. And guess what we continued to do? Spend, spend, spend in a very inflationary environment. And now they're just like, what do we do? Because it's almost like stagflation, which I loosely understand that term. And so I just think that it's just kind of like nothing's happening. Like it's like gridlock, kind of like we see in the real estate market where it's like buyers aren't really wanting to buy and sellers really aren't to sell, but things are moving. It's just like a slow pace.
Right. And I mean, stagflation, I think is just high inflation with low unemployment. It's like one of the things that they their mandates that they try to meet.
Right.
But I don't really know what this means either, other than what's the saying is like, history sometimes doesn't repeat, but it often rhymes. And so like all these historians will come back and like, okay, well, this is what happened before, but it's never the exact scenarios that you're in before. Yep. Right. But if you do plot out like those like M2 money graphs, right, post COVID, and that data goes all the way back to like the 1900, right? Yeah. That is unprecedented. So the question for me is like, okay, what does happen next? And I'm not saying we're going to get it right, but it's better to be informed than uninformed, in my opinion.
Right.
And everyone I listen to is like, they like the Fed, meaning like the Federal Reserve, and also Congress, like the Treasury Department, don't have any more options. Because when that COVID time happened, they restructured a lot of the debt. So they got locked in at 2.5%, 3% rates. Mm-hmm. Well, now that those are coming due, they're having to lock in at 5%, 6%, 7% rates. And so now our deficit just keeps getting bigger and bigger. And a large portion of that deficit is just going to interest expenses.
Yep.
Right. So a third of the deficit is just paying the interest on our own debt. Yep. How do you get out of that? You can't without like some kind of recession, in my opinion. Right.
Totally.
So
yeah, it's like having a credit card that eventually your fees and your interest are bigger than the principal.
Yeah.
Right.
Yeah.
You know, and then you only make enough money to pay the interest, and the only way to get out of that, you're saying like recession. So that's actually one thing that a lot of conservative economists like would applaud Donald Trump for. Was his plan was to do 100-year 0% interest 100-year bonds, which back then people were like, you're an idiot. It actually makes sense now because we would have restructured our debt as a country to be like low interest, right? Which would have been super cool. But outside of that happening, because it didn't happen, the point of my bringing that up is that we have to figure out how to bring interest rate down, which could be to drive the economy into a recession so that you can lower interest rates and then you can restructure debt again.
Right. And I think that's it. But then when you lower interest rates, to me, that's just going to kick inflation up higher than it already is, right? And we have these other factors too. So this is the battle that they're facing, and I don't know if there's even an answer. But okay, so how does this affect, us as real estate investors in our local markets? I think when shit does hit the fan, because I think it'll happen eventually, no one knows when. But as long as you have a solid portfolio, like fixed debt, don't get these adjustable rate debts on all of your properties. And you have some money in the bank, you'd be able to take advantage a lot and really like change your life during those 1 to 3 years after whatever that happens.
Absolutely. Yeah. There's always an opportunity, and don't let like fear overcome, because honestly, I didn't know to be fearful when COVID hit, and all the OGs that were wholesalers back in 2020, 2019, when I first started, were basically like, we're out, like we're done. Like we don't know what's going to happen next. And I was like, well, I'm kind of committed here. Like I'm sending mail out. Like I might as well at least like try to get my money back. And we just went all in. Right. And we didn't know to be fearful because we didn't know what we didn't know. And you'll always hear the big dogs or the OGs talking about like how they're going to cool it. It's like, yeah, they earned the right to cool it. And they're going to miss a huge opportunity, right? Because they're not willing to risk, because they've already taken their risk. They made big money, and now they're sitting back and saying, I don't really want to risk my 10, 20, 100 million, whatever there is, whatever portfolio is, because like I don't need to anymore. When you're first starting out, you kind of need to risk it. But the good thing is you have less to risk, so that your downside is lower.
Yeah.
So
what do you have to lose at the beginning? I mean,
exactly. And so you got to risk it to get the biscuit, as they would say. And I agree with you 100%.
My tangent here that I'm going to go on is my, not gripe, because all of these people would have been successful no matter what, but the early bigger pockets crowd, like the ones that got in from like 2010 to really like to present to really like 2020.
Yeah.
Would they have all been successful? Probably. Would they have been as successful to the extent that they were? Maybe not. because they just had the biggest tailwind in real estate probably ever in the past decade. Right.
Yep.
And so, but they didn't know that. No one knew that going in. So it still had the balls to go like move forward with it. But
yeah. And they all wrote books on how badass their strategy was. And their strategy wasn't anything good. Right. David Green keeps writing books, and I don't know what he could possibly be writing books about, because he doesn't do anything crazy, and he hasn't done anything that wasn't something Brandon Turner already did.
It's just books on how he can reword every phrase with a different analogy.
Exactly, dude. They should just rename it the Bigger Analogies Podcast.
There you go.
Anything else, Dylan? What else should we chat about?
Dan, I didn't really have much planned for today. Is there anything currently on your mind that you want to dive into?
No, I don't have anything I want to dive into. I just really hope that Michael's okay out there and that we can get him back next week for the Mike and Dan show.
We'll see. This is kind of nice having without him.
It was a lot quieter. But in all seriousness, he will be back. I think you will have, when this episode drops, you will get to hear one of his Friday focuses on his time at the Alex Hormozi 2-day event. And then the next Friday focus, I think he's going to drop it. So as this airs, make sure you tune in for this Friday's focus, because you'll get the second half, the second day of that. And Mike and I got upsold. So we're going back. We're going back to a deeper dive workshop, because the first one was so good, and you'll get to hear all about that from us as we kind of dive into that and learn more about it.
I read some of that on Mike's newsletter right before we hopped on this. Looked like it was, it looked like he had some good bullet points on there.
Yeah, especially from like building a business standpoint, like there's just a ton of good systematization stuff that we learn, and just good, like basic, like, you should do it this way. There's a lot of things that are kind of like moments where you're like, it, but then having somebody that's so successful break it down that simple, it makes it so much more palatable, I guess, for yourself.
He is the best business articulator that I think I could listen to. Like,
yeah, right. Layman's terms, simple, and analogies and things you can understand. And obviously he practices what he preaches. If you are a listener here and you would like to practice what you preach, you should go and share this podcast with somebody, because that's how we grow the show. We desperately need you to share the podcast, to share the word, to share the good gospel, and go download our episodes, because that's what helps us grow the show. It helps us grow our influence out there. If you want to connect with me or Mike, I'm at Investorman Dan on all platforms. Mike is at Mike_invest. And Dylan, what's your handle?
It's just 11D and then KOCH. 11D Cook.
11D Cook on Instagram. All right.
On Instagram.
Have a good day, Dylan. See you guys all next week.
See you guys.